Welcome, everybody. Our topic here today, how to avoid capital gains taxes. This is a topic that affects everyone. If you own any stock, if you own any real estate, if you have a business, capital gains tax are an issue. If you own baseball cards, if you own NFTs, if you own crypto, really any asset, capital gains taxes are a big challenge. And as we get started, just a reminder, the only certainties in life, as they say, death and taxes, right? But maybe not capital gains taxes. Maybe we can avoid those. Now, how can we avoid those? Well, the first thing is you can't have your head in the sand. If you just don't want to think about these issues, you don't want to plan, you don't want to get advice, you're probably going to face capital gains taxes. And we, every once in a while, will have families come in and they talk to us right after they made a big move that cost them hundreds of thousands of dollars in capital gains taxes because they didn't talk to advisors first. So we want you to be part of the group that is advised, that has the right team around you, and is armed with the ability to avoid capital gains taxes. Now, what are we going to talk about here today? We're going to be very efficient. So we're going to explain what are capital gains taxes. Many of you may be very familiar with this. I know a lot of people are sort of familiar with it, but they don't quite understand all the terms or the rules around it. We're going to go through that. And is there a get out of jail free card for capital gains taxes? There is. We're going to talk about that. But we're also going to talk about how you can avoid them for your home, for rental real estate, but also for appreciated stock and other investments. We're also going to just mention, we want to hammer this for our client community. We're going to be talking about your home and rental properties. If you have those, you have to be aware of Prop 19. That's not the topic today, but everything that you're thinking about with real estate, if you want it to be there for your kids, you need to be aware of that. We do have solutions for that. We're going to circle back about that. We want to make sure that your estate plan addresses this. We're going to talk about what that means as well. I want to just flag this is an educational webinar. It's not official legal advice. We can't provide that unless we're meeting with you as a client. It doesn't form an attorney-client relationship. And on that note, we do want to welcome all of our existing clients who are viewing this or here today. Of course, welcome people who don't know us as well. Mike, anything you want to add about today's agenda? Any things you want to flag up front before we kind of dive in?
No, I think I just emphasized the point you made about the intersection of these tax issues, that we are going to focus on capital gains tax today, but the considerations to planning alternatives raise gift tax, estate tax, property tax issues. So again, we have our focus today. We'll make reference to some of these other tax issues that are affected, but always to be aware that you can't take capital gains taxes and just focus on that and go do it at home. You really have to integrate your thinking, make sure you have a comprehensive plan, certainly taking these taxes into account. So our job today is to kind of show how those things interrelate, and we'll be real practical as we here today.
And the focus here is not to go into too much depth in any one of these areas, but to give you just an idea of the tools that are out there. You could give a 3-hour talk on any one of these subjects. We want to make you aware of the key issues and what you need to understand. And just for those of you who don't know us, I'm Mark Gilfix. This is Michael Gilfix alongside me. Yes, we are a father and son team, but we're part of a much bigger team, and that's Gilfix and LaPole Associates. We have 6 estate planning attorneys. We have a wonderful team. We're very proud of our heritage. Michael Gilfix, along with my mother, Myra Gerson Gilfix, really started the field of elder law back in 1973 when they graduated. He graduated from the Stanford Law School and started America's first free legal aid program for the elderly, SALA, Senior Adults Legal Assistance. Still exists to this day. He went around the country, proselytizing, raising money, testifying in front of Congress to raise money, and really creating the field of elder law. Later transitioned into our firm that is now Gilfix and LaPole Associates. Francis LaPole, our outstanding tax guru, been in the Bay Area, Palo Alto area for over 38 years. We've served thousands of families throughout California, especially with Zoom these days. We serve clients all the way from San Diego all the way up to Wairika. So we help families throughout the state of California. Very proud that we've been featured in the national media. We speak regularly. We're passionate about these issues, and we want to empower you with information that you can use to save your hard-earned family assets. Our goal is to provide extraordinary value and peace of mind. And that's what this is all about. So we want you to share the word, spread the word about what you're learning here today.
And before you leave this slide, this PowerPoint, I got to say, that is Mark.
Yes.
That is Mark in that picture in his grandfather's arms, and that's his mom, my wife Myra, on the right side. So you get to see Mark's evolution here.
Yes, I'll try to match that. Yes. So let's jump in now.
Okay, substance.
What are capital gains taxes? Mike, do you want to talk about that?
Okay, so you probably know capital gains taxes are taxes on the profit that you realize, and we're going to focus on long-term capital gains today just to keep it simple. On the profit, so you buy an asset for some value, $10, you sell it later for 20, well, you had a $10 profit or capital gain, and that's the capital gains tax that you pay. It's owed for the year in which you realize the gain. Filed by April 15, it's part of your income tax return. So, let's make the important point that, and we'll come back to this, that capital gains taxes are taxes of choice. If you don't sell an asset, you don't have capital gains tax. So it's an act of volition. So the simplest way to avoid capital gains taxes, of course, is not to sell an asset. Now,
and one thing I want to clarify, actually, it's the gain, the tax is on the gain. The tax is not the gain. It's a tax on the gain. Just to clarify.
Okay, right. So
yes.
We have the gain, and then in a moment we'll get to what the tax rate is. So let's take your home, for example, a piece of real property. The starting point is to figure out what the cost basis is. In other words, what did you pay for it? For a share of stock, it's obvious, whatever price you paid. A share of a mutual fund, the price you paid. And now records are kept, so it's pretty easy to figure out what that is. For your home or real property, it's the price you pay plus capital improvements. So this kind of underscores the need to keep track of those improvements, not just because you want to show a potential buyer someday, but it adds to the cost basis. Okay, so capital investments plus the price you paid may come to $400,000, $500,000. You sell for more, again, the gain, the profit, that's the capital gains tax. That's the capital gain. That's what's exposed to the capital gains tax. Okay, so I think that's pretty clear, but we'll certainly entertain any questions. Okay, what are the taxes? Roughly, we think of it in terms of a third. California is not gentle with regard, no shocker there, right? California and taxes, not gentle. We have a very high state capital gains tax rate, and the federal rate is 20%. So think of it as roughly 1/3 of the profit or gain is lost to taxes. So it's a significant number. We have to be really cognizant and think about what the alternatives are. And by the way, taxes, this might sound like a heretical comment. Taxes are not the worst thing under the sun. Sometimes you need to sell an asset, you need money, you're worried about your investment. Now, who would be worried about a portfolio these days? I mean, who would be? No, nobody. So sometimes you sell, maybe you have some tax, but you're done with, then you're out of that asset. So we're not saying never, ever, ever accept these taxes. They're always to be avoided. Yeah. No, but the focus again is what can you do to minimize or eliminate them when you want to do so.
Now, is there a get out of jail free card? Well, yes, but you have to die to get it. But that's actually a crucial concept as we think about these issues. So this is a key concept. When everything in your taxable estate, everything's included in the IRS definition of what your taxable estate is, meaning it's exposed to estate taxes, gets the benefit of a stepped up basis when you pass away. Now, we'll go into what that means in just a moment, but it's a massive benefit to your surviving family members. And in simple summary, it means, Mike talked about we'll have some examples, but let's say you have a house you've had for 30 years, you paid $100,000 for it, now it's worth $2 million. If you were to sell it now, that's a huge gain. And your family would be exposed, you and your family would be exposed to hundreds of thousands of dollars in taxes, in capital gains taxes. If that house is in your estate when you pass away, the IRS doesn't care what you paid for it 30 years ago. The IRS only cares about what the value of that house was on the day that you passed away. And that's the new number used for the cost basis, meaning this massive taxable gain is wiped away. Now, yeah, someone has to die to get this, But it's a really important concept to understand, because if we can put off the sale of a property, if you can find ways to keep assets in your family, when you pass away, those taxes go away, and they are reset. They could accrue again as the value of assets go up in the future. But let's give an example of what this means. So let's use stock. I'm just going to use this example. So let's say your grandfather bought Apple stock for $10 a share. It's now worth $150 a share. I'm not sure what the value is today, but it's actually around that. If he sells it while he's still alive, well, you have to report $150 sales price minus a $10 cost basis. That's a $140 taxable gain per share. So that ends up being about $46 per share is lost in capital gains tax. That has to be paid to the IRS. If grandpa holds on to that stock and he leaves it to his kids, if they sell it the day after he passes away, they have the stepped up basis, meaning the IRS doesn't care that grandpa paid $10 for those shares many, many years ago. They only care that the shares were worth $150 on the day he passed away. If the family members sell it for $150, well, what's the gain on a $150 share of something where the cost basis is $150? Zero. So we just eliminated a $46 per share tax by holding on to those shares until grandpa passed away and the assets went to the kids. They can sell it for much less. So
Let me add just one refinement that if grandpa bought it and there's grandfather and grandmother and they own it together in their trust, at the first death, there's a stepped up basis. So it doesn't wait till the second death where there's a married couple. And that kind of liberates the survivor to be able to sell that stock. And again, no capital gains tax. And then again, if the survivor has it in her estate, another stepped up basis.
Yeah. And I see a couple of questions are coming in. Please enter those in the Q&A function. We'll get to those as we can towards the end here. So now let's talk about selling your home. I had a slide there about long-term care. We're going to actually circle back to some implications for long-term care as they relate to your home. Home values have risen. You don't need me to convince you. Home values have risen massively over the past 10 years, really over the past 30, 40 years. And yes, right now the market is in a bit of a pause, but this is a blip in a long-term upward trend. The sale of your home may result in the largest tax bill of your life. And I don't think that's an exaggeration. For the majority of families in America, and certainly in California, the sale of their home, if they don't do it right, will be the largest tax bill they will ever pay. So why would you be selling your home? Well, Mike, why don't you talk about some of the reasons people want to sell their home these days, despite this?
Yeah, happens all the time. The kids are gone. You don't need the big house anymore. You're going to downsize. It makes sense. Move to a condo, move to something that's more accessible. Logical thinking. You might relocate. You're sick of California. You're sick of the taxes. You want that Arizona sun, whatever it may be. So relocation, move to be closer to the grandkids. I mean, doesn't that happen all the time? You might want to avoid California income tax, so you want to get out of this state. We hear that a few times. Liquidity, you want to travel, you want to do other things, you want to invest in something you're really concerned, you really care about. So many motivations, but again, the caveat here is to be careful, is just to understand the implications of selling your property. And again, record keeping as to capital improvements. So critically important. So often it's a motivation. It makes a lot of sense for many folks. So, okay, let's move on now. Let's talk about some of the tips, some of the approaches that we think about. Mark?
Capital gains tax tip number one for today. Well, your primary residence gets some income, some capital gains tax breaks. So let's say you want to sell a property, maybe you have two. Well, move to the one you're about to sell 2 years ahead of time. Or if it is your residence, make sure that it remains your residence before you sell it. That can protect up to $500,000 in capital gains from taxes. That's been a rule for a long time. So an individual, if you live in your house 2 of the last 5 years before you sell it and it's your primary residence, you get to protect $250,000 in gains from capital gains tax exposure. So if you bought a house for $500,000, you sell it for $750,000, 3 years later, you live there the whole time, you're single, you don't have to pay any capital gains taxes. The first $250,000 in gains are protected. And if you're a married couple, you both live there, well, you get 2 times that $250,000 protection. So that's $500,000 in gains that can be protected. We know, I've heard stories of people who flip homes. They try to, they move in as a couple, they fix it up, they live there for 2 years. They hope that their flip makes it worth $500,000 more. They sell it. They don't pay any capital gains taxes. They do the next house. That's a challenging way to do it, but you can do that. That's taking advantage of it. So everybody can benefit from this. And so where it's sort of a trick is, let's say you have two properties and again, you want to sell one. Well, maybe you want to move into the one a couple of years ahead of time that you're going to sell, and then you can protect $500,000 in taxes. So let's give an example here.
Well, Mark, let me give tip 1A.
Okay.
If you're a single person, get married.
There you
Right?
go.
You just save another $250,000 in capital gains tax. So while we have had a number of situations where couples were living together, but they weren't married, and they didn't see a reason why, this is actually a motivation to get married, save another $70,000, $80,000 in capital gains tax. So tip 1A.
1A, get married. There you go. That also has estate tax benefits, by the way.
Yeah, it really is.
Protecting 12.06 million to protecting 24.12 million. Different topic, but important. So let's just give an example here. I'm happy to walk through some, Mike, feel free to chime in here, but let's just say, you have a primary residence. Again, we talked about $250,000 per person capital gains tax exemption or protection, up to $500,000 if owned by a couple. Let's say you have a $3.3 million residence, which in many parts of California is a just okay single family home, which still boggles my mind how expensive houses are here. But let's say you bought it for $200,000. You put $100,000 in capital improvements into the home over the years, a new kitchen, maybe you remodeled the bathrooms. That means, as Mike mentioned before, you add your purchase price plus any capital improvements. That gets us to a $300,000 cost basis. Let's say you sell it for $3.3 million many, many years later. Well, you have a gain of $3 million, $3.3 million sales price minus the $300,000 cost basis. But if you're married and you both live there, you have a $500,000 protection there. So there's really only a $2.5 million gain, only a $2.5 million taxable gain. Hey, you're still looking at losing over $800,000 in capital gains taxes. So it's nice, but if you've owned a house in California in certain areas for a long time, that doesn't really protect you from everything. It's nice, but you still could have massive capital gains tax exposure. Another issue we want to flag. We've talked about selling your house. We think about multi-generational planning. We think about long-term care. We work with a lot of families dealing with long-term care issues. Aside from capital gains taxes, there are some reasons why you might not want to sell your house as it relates to long-term care issues. And Mike, do you want to just talk about that?
Sure. The residence it's on a pedestal in so many contexts. The residence is a protected, hallowed asset. In the context of Medi-Cal qualifying for this program to pay nursing home bills, for example, the value of your home is exempt. It doesn't count. It could be worth $5, $8, $10 million. Doesn't count. So you can retain ownership of your house, qualify for this incredibly important government benefit. If you sell because you might think you need money to pay for care, well, not only did you lose the exempt asset, now you have cash. You're going to be ineligible for Medi-Cal. You have to pay privately using that money, and you absorb the capital gains tax. So really dicey when you're looking at the issue of long-term care. You just have to talk with us. There's so many issues, tax among them. How do you protect assets, qualify for Medi-Cal if you wish to do so? That's another one. So being really careful about protecting the value of your residence in the context of long-term care thinking and long-term care planning. So again, you're going to lose that stepped up basis if you sell while you're living. Critically important. Be real careful.
And I want to flag, this is not a key topic here, but this also relates to reverse mortgages. So we see ads like Tom Selleck and a few other people pitching reverse mortgages as the best thing under the sun. There's no downside. They're great. And in some situations, they're not bad in all situations. But here's the big issue as it relates to long-term care and capital gains taxes. If you get a reverse mortgage, that means you're taking money back for the value of your home, and the reverse mortgage company only gets paid when the home is sold later. The problem, though, is what if you need long-term care and you can no longer stay in your home? Well, every reverse mortgage policy I've seen says that a clock starts ticking the moment that you move out of the house. And within 6 months or at most a year, if you move out of your house, that loan becomes due. So what does that mean? It means your house has to get sold. And what does that mean? Massive capital gains tax exposure. So if you have kids and you want to leave the house for your kids, they just lost out on that crucial stepped up basis. So all this to say, the capital gains tax issue is a big one, and it relates to a lot of different strategies you might think about for your home. So talk to us before you think about selling your home, and we can go through a lot of these issues. Let's go to tip number 2, and this relates to rental property or business properties. So if you have a rental property or a business property, you can use a 1031 exchange to avoid capital gains taxes. And we'll just flag this. If you do think you may want to be selling your residence, maybe convert it to a rental before you sell it. You'll see why that can be an extraordinary tool in just a moment. So Mike, why don't you go through what 1031 exchanges are? We're not going into the nitty gritty details of it, just high level, but it's important that everybody understands this.
Sure, and this is tried and true. And there were some efforts in Congress to curtail or eliminate this option in many contexts, but that went nowhere. Okay, so you have a business property. Let's say you have a fourplex in Santa Clara, and it's not being real productive. You have a lot of equity in it. You'd like to trade up, shall we say? Okay, you can sell that property, and if you just keep the money, you're going to face the capital gains tax, which for really, it's higher income folks who have the 20% federal capital gains tax rate. A comment in the Q&A pointed out that when your income is lower, for most, it's actually 15%, but 15, 20%, still huge either way. Okay, yeah. So you sell that property, and rather than keep the money and pay capital gains tax on the gain, you take that money and you buy a replacement investment property. So let's say you sell that property for $3 million, just to make up a number. Your capital gains tax might be $500,000, whatever it may be. You don't pay it. You take that money, you buy a different new investment property. You buy a 10-unit apartment building in Phoenix, Arizona. You just avoided all the capital gains tax. There are professionals in the business of focusing on 1031 exchanges. We've helped many clients with that process as well. We being our tax attorney, who's also a realtor, Mr. LaPole. Okay, when the new property is purchased, the basis that you have in the original property, in my hypothetical for that fourplex that you bought many years ago, maybe it was $500,000. That basis carries over to the new property. Usually when you buy a piece of property, the cost basis is what you paid for it. Now with the 1031 exchange, again, that low basis you had earlier, it transfers to the new property. So again, if you sell that property, you would have an even more substantial capital gains tax problem. If you hold on to it until your passing and it's in your taxable estate, stepped up basis, there we go. So you might have improved your investment, increased your income because you're in a better environment, a more productive asset, and you've avoided all the capital gains tax by the exchange. For your kids, for the next generation, stepped up basis when you pass away, all the capital gains tax is eliminated. And by the way, you'll see very wealthy people doing exchanges with business properties, apartment buildings, office buildings, things like that. It's massive in its impact, and it facilitates, the distribution of capital. In many ways, it's a good thing, and that's one of the arguments, in fact, against the elimination of the 1031 exchange when this is being debated in Congress.
Yeah, and you hold the idea is if you want more income, you get out of an area like ours that's very expensive, that people are kind of banking on appreciation and value, and go to an area where maybe values don't go up as much, but you get a lot more cash flow every month in rental income, and it can support your lifestyle, and you keep doing that. And then when you pass away, hey, you get that stepped up basis, that get out of jail free card that we talked about. So we have many higher net worth clients who that's been what their parents did, and that's what they're doing, a series of 1031 exchanges. And then you hold until someone passes away. It can be just a spouse, and then the rest of the family can then sell the real estate and avoid capital gains taxes. Now, I think this is crucial. If you live in a high home value area, you need to think about a 1031 exchange as it might apply to your home. So, hey, let's expand our minds and our thinking. And we have many realtor friends and they're great, but we have a lot of clients that I just talked to my realtor. They said, I can get so much money for my house. I think I'm going to sell. Wait a little bit. If you can convert your house to a rental property, it might take up to 2 years, but if you can convert to a rental property, it means renting it out. Who cares if you make good cash flow for those 2 years? If you can wait a little bit to sell your house, then it becomes a rental property and you can do a 1031 exchange and take all that gain that you have in your single family resident and convert it into a rental property that can produce a ton of income for you without losing that massive chunk of money that you'd have to pay in capital gains taxes otherwise. Any thoughts there, Mike? I think it's a really interesting concept. We've helped many of our clients to do this. It takes a little bit of patience, but I mean, if you can save $800,000 or $900,000 that would have gone to the IRS and have that go into a productive rental property that can produce income for the rest of your life, I mean, why not? If you have the patience. I think too many people want to just get it done, jump the gun, and they don't do it. I think that's a crucial tip, that maybe that's the only thing you take away from this. If that's it, hey, great, but that's a crucial concept. So, but it has to be part of your overall estate plan, by the way. You think about this strategically. There's a lot of implications, but I think that's a really important idea.
Okay.
So now anything you want to add?
Oh, yeah. Okay. So, how many times have we heard and read experts, others say that you can't use a 1031 exchange for your residence. Can't do that. Well, that's true so long as it is your residence. So, just be a little bit creative here. To go to a simple extreme, you move out, you rent out your house. You could also convert a portion of your house to a rental. It isn't all or nothing. So the math becomes very interesting. You have a lease. I mean, you actually collect rent. You pay income tax on the rent that you collect. We believe that is possible. So let me give you a real life example. Clients living in Los Altos about a year ago finalized the implementation of their plan. They sold their house. They were going to rent it out, but they didn't like the idea of somebody staying in their house long term. A lot of memories. They did obviously rent it out for a considerable amount of time. They weren't going to get a lot of rental income, and they were going to have a lot of worries if they did that. So what they did is they sold, and they took all the money that they got, and they bought, I think it was a 12-unit apartment building in Arizona in a nice area, and they paid cash. No loan, because it was ample funds given what you pay for, what your property is worth here. You go anywhere else, and it's just dramatic, the difference. So they immediately had a dramatic and significant income stream from the new apartment building. And I think it was significant, by the way, that it was in another state, so they couldn't worry about it. They had to have a property manager. So there wasn't worry about, who's going to fix the toilet? You had a property manager there taking care of everything. So again, they turned their home and they moved into what's called a CCR, a continuing care retirement community, a life care community. Plenty of money for access and very comfortable retirement. They're doing a lot of traveling on all that money right now.
They converted their house into a rental and used that for 1031 exchange. So I mean, we have many examples of people who planned ahead. And then unfortunately, we have many people who had just sold their houses before they talked to us and already paid those taxes. It's not right for everybody. We want you to be aware that you can do this. Let's talk now about stock, now or other investments. Do you have stock but you don't want to lose 33% of your gains? And hey, do you want to support charities and get the benefit of lifelong income? Well, we have an amazing estate planning tool that we can use, and that's Charitable Remainder Trusts. These are not the only tools we have to deal with appreciated stock and other assets, but these are probably the most common, and they can be wonderful tools in some situations. Their way can be win-win approaches to avoiding capital gains taxes, supporting charities, and supporting your family. So again, appreciated stock, if you sell it, you're normally subject to a full 32 or 33% capital gains tax rate. It's a range depending on your income level, but it's a very high tax rate. You can use charitable remainder trusts to take the full value of that appreciated stock to support the charity or charities of your choice, to get an income tax deduction upfront, and to get lifelong payments in return. So Mike, why don't you talk just a little bit more about how they work and what they are?
Okay, so again, this can be stock. It could be a piece of real property. any asset you have that if you sold it, you would have capital gains tax exposure. You don't like that idea, and you may be charitably inclined. There's a nonprofit you've worked with at your university, and you're attracted to the idea of charitable giving, and this is a very tax-wise way of doing it. And I got to tell you, we've had a number of folks who don't have a charitable bone in their bodies do this because it made such tax sense, especially as we play this out a little bit more and talk about life insurance in just a couple of minutes. Okay, so the idea here is, again, you take your stock, we'll stick with the stock example, you transfer it into the Charitable Remainder Trust, and there are different types of Charitable Remainder Trusts. There's unit trusts, there's annuity trusts. We're not going to get into that today. That's, the details are not the point.
We'll give a high level summary. Yeah.
The asset goes into that entity, and then the stock is sold. Maybe not, but usually that stock would be sold to develop, to invest the assets and give you an income stream for life. You might identify a certain percentage, 5%, 7%, maybe more of the assets in the trust are going to come back to you annually for the rest of your life. You may have a fixed amount that would be the Charitable Remainder Annuity Trust. But again, you're locking in income for life. At your death, the money doesn't go to your family. It goes to a tax-exempt organization. We usually write that trust, by the way, so that you retain the right to change the ultimate nonprofit organization, tax-exempt organization that's going to receive the money. The organization that's the darling of the day may not be one that you like in 10 years. So nice to retain that right to change the identity of the ultimate recipient of these assets. So it can be very positive. You convert that asset into an income stream, you're getting an income tax deduction. Makes a whole lot of sense for so many individuals, particularly for those of you who really do want to support a charity where you're going to get personal benefits for your family as well. So here's the unit trust. The idea here is you say, let's say it's 5%. If you have, if the stock, whatever it is that you put into the Charitable Remainder Trust is sold, and then it's reinvested. It doesn't sit there as it could, but you wouldn't have it sit there as cash. The hypothetical, shattered by today's market, is that the value of those underlying assets are going to grow. And most of us are optimists around here. Well, if you put in $1 million and it grows to $1.1 million, you're going to get 5% of $1.1 million next year. So your distribution is going to grow if the value goes up or go down. The Charitable Remainder Annuity Trust says you're going to get X dollars, $50,000 a year for life, period, even if the value goes way up or even if the value goes down. That's why the Charitable Remainder Annuity Trust, the CRAT, is more conservative. You're locking in an income stream pretty much no matter what. So, and there's other choices to make when you implement this approach, but those are sort of conceptually, those are this is one of the most important decisions you make when you pursue this approach. Okay, now why did I mention life insurance a few minutes ago? Historically, many planners have referred to life insurance and an irrevocable life insurance trust as a replacement, as a way of replacing the wealth that was otherwise going to go to your kids. So here's the idea. You have this stock that was not generating any dividends at all, sitting there, nice value. Now you're going to get an income stream. So you have income, in my hypothetical a moment ago, about $50,000 a year that you didn't have before. Okay, 5% $1 million asset. So here's $50,000 you didn't have before. You could take all or most of that $50,000, maybe just for a number of years, and purchase a life insurance policy with that money you didn't have before, a life insurance policy you didn't have before. But you don't own that life insurance policy, because if you do, the death benefit, $1 million, $2 million, whatever it is, that's part of your taxable estate. Now, if your estate is relatively small and there's no estate tax worries, doesn't matter if you own it. By putting the money into an irrevocable life insurance trust and having the trust buy the life insurance policy on your life, the death benefit is not going to be part of your taxable estate. So if you do have a taxable estate, and again, it's going to be about $12 million for a couple come 2026, if that's an issue, we would not just talk with you about buying a life insurance policy, assuming you're insurable, of course, but also using this irrevocable life insurance trust tool to keep it out of your taxable estate. Presumptively, your kids, your grandkids, maybe dynasty trusts that you've established for those kids, they're going to be the beneficiaries of that life insurance policy that you used with the income you now have from the Charitable Remainder Trust to replace the wealth that's now going to go to the charity upon your passing because of the assets you transferred into the CRT. It all
and this is
ties together.
And this is getting kind of next level planning. And I think the illustration that the point that we want to make is we can layer in multiple tools. And when we're thinking about these, you need to think in an integrative, holistic way. All these issues relate together. And that's where we help our clients to think about this in an integrated way. And I've seen some analyses of charitable remainder trusts and the cash flows you get, where they showed that people actually end up with far more money at the end of the day, even with the charities getting supported, than they would have had they just held on to the stock. So it can be not only win-win, it can be win-win-win. Like not only do you avoid capital gains tax, not only do you support charities, not only get income, but you can also actually end up at the end of the day with more in your estate significantly in tax protected ways than you would have without doing these tools. So the charitable side of this is wonderful. And you may end up ahead financially on your own, for your own family, when you integrate all these tools. So it's just important to understand all these tools out there. Again, our purpose here today is not to go over every tool available. This is just, I think, one of the most prominent ones, charitable remainder trusts. But there are tools out there and they have to be integrated with your overall estate plan. I do want to circle back, and this addresses a couple of the questions we've gotten. We will get to some questions here at the end. Real estate. We have given a lot of talks about Prop 19 and the fact that now if you want to keep property taxes in your family, you have to be aware of the fact that there almost certainly, without planning, will be a massive property tax reassessment. And yes, if a property is in your estate when you pass away, you get a stepped up cost basis. That means your family can sell an asset with little or no capital gains tax exposure. But if they hold on to that house, unless you plan ahead, property taxes can and almost likely will spike, especially if you've had a property for a long time. So we gave a webinar on this, how to preserve low property taxes. It's on our Gilfix Law YouTube channel. Check that out if you want to learn more about it. But if you have a house that is worth 2 or 3 million more than you paid for it, if you have any rental properties in California, and if you want to preserve those for your kids, there are tools available to keep property taxes low. And crucially, we have to be aware of the fact that some of the tools we can use to keep property taxes low ostensibly on the surface seem like, well, that means you're giving them away to your kids right away. We can use LLCs and other entities to transfer ownership without property tax increases, but we don't want your family to lose out on that stepped up cost basis. And that's where sophisticated integrated planning is absolutely crucial. And we can address both of those issues. We can address the stepped up basis. We can address property tax issues. Talk to us if you have questions about it. It is a very customized approach for each family, depending on your situation. We have to be aware of estate taxes, property taxes, capital gains taxes. We have to weigh all these, but we can come up with solutions that work for you. So we don't want to be capital gains tax smart, but property tax dumb. We don't want to be property tax smart, but capital gains tax dumb. We don't want to be estate tax smart, but capital gains tax dumb. There's a lot of integrated issues. We just have to be aware of it. And that's what we do. We live and breathe this stuff day in, day out. I think this is an important point, right, Mike? Capital gains is a tax of choice.
Earlier, actually, again, it's a tax of choice. If you don't sell, no capital gains taxes. And let's take just a moment and talk about your trust. If you're our clients, you certainly have a trust. We've talked with you about whether it should be this AB trust where it divides into two after the first death or not. There's been some developments in this area that create some real opportunities. Bottom line is that if you have the AB trust, again, it says that after the first death, the estate divides into two subtrusts after the first death. Half of the assets, the portion of the assets that go into one of the subtrusts do not get a second stepped up basis at the second death, whereas the other does. So thinking about that, thinking about the benefits, the protections, weighing capital gains and estate tax issues, it's not a simple question. I will say that if you have the AB trust, you need to talk with us or your estate planning attorney if you don't want to talk with us, oddly. about the alternative approach. The alternative approach allows for a complete stepped-up basis for all assets at the first death and a complete stepped-up basis for assets at the second death as well, which can make an enormous difference if assets continue to increase in value after the first death. So
Yeah,
again, and no simple answer for everybody. It depends on your circumstances. Your trust has to be reviewed in this context.
and here we're talking about your revocable living trust, something that everybody should have, not the charitable remainder trust. This is what you need to have in place, or a revocable living trust. And if you're not even sure if you have an AB trust or a non-AB trust, you need to have it reviewed, and we can help you with that. If it's been certainly a few years since you last spoke to somebody about this or reviewed it, you can absolutely take a fresh look with us, and we can very quickly tell you if you have massive capital gains tax problems or not. It depends on your situation, but review your living trust every 3 to 5 years. We can help review your trust. Most trusts done 15, 20 years ago used AB structures. So if you did your trust a long time ago, it probably has that. You may be unnecessarily exposing your family to hundreds of thousands of dollars in capital gains tax exposure. So we can help take a look and make sure that your trust is properly set up to address both estate tax issues and capital gains tax issues. So we went through a lot here today. We will get to a couple questions here at the end, but we're here to help. We want you to be empowered by all this information. Please spread the word. If you know anybody else who could benefit from this, if you're watching this as a YouTube video, please share this, like the video, subscribe to our channel. So we of course welcome you to work with us. If you're an existing client, set a review meeting, we can do that. If you're a new client and you can set a meeting with us, we typically charge hourly for our initial planning meeting so we can dive in. If you'd like to chat with us for just a few minutes, we're happy to chat with you for 15 minutes just to see if we're a fit for you, to understand how we do things. But of course, we invite you to set a meeting with us. The documents that make up your estate plan and the decisions you make around real estate, stocks, structuring your estate plan, these are the most important decisions you're going to make in your entire life. And these are the most important documents you will ever sign. So don't delay. If you're not sure about this, give us the opportunity to help you. We'd love the privilege of serving you and your family. If you'd like to set a meeting with us, you can go to gilfix.com/my-needs, and you can kind of check boxes for areas you're interested in. We can help you in a lot of different areas. You can also leave your contact information in the Q&A, like your name and your email or number, and we'll reach out to you. A lot of people have done that in the last few webinars we've given. You can also call us at 650-493-8070. 650-493-8070. Gilfix.com is our website. It's very easy to find us. You can also just contact us through there. I think we have a different number there. That's fine. It's a different tracking number. The bottom line is we would welcome the opportunity to help you. If it's been a long time since you addressed your estate plan, take a fresh look. Your living trust by itself, we didn't spend much time on that. Maybe we should have spent a little more time. Maybe we'll do another talk about that. The structure of your living trust can have massive implications here. But especially these issues all relate to real estate, they relate to stock, they relate to your legacy. We can help you think about this. But capital gains taxes are not a certainty. There are ways to avoid them. I hope you got a lot out of this here today. Any final thoughts, Mike, before we go to some questions?
No, we have some really good questions, and I've reviewed them, so I'm primed and ready to go. But
all right, well, so again, if you're watching this as a recording, please like the video, share it, subscribe to our channel. Now let's get to some questions. I see a couple of people have given their contact information as well. So Mike, do you want to get to a couple of these?
Sure. One question, obviously a real property owner, can we do an LLC for the property? Different issue, but of course we can. That's done often and it makes a lot of sense for rental properties. So yes, we certainly can. If there are 3 owners of a piece of property, let's say each owns a 1/3 interest and one dies, what happens with the stepped up basis? The 1/3 interest owned by the one who died gets a stepped up basis. The other 2/3 remain the same. If you're a married couple, there's a complete stepped up basis. But if you're single, only the portion that's in your estate is going to get that stepped up basis. There's a question about whether if you inherit stock and you don't sell it, is there any tax on that? Only if the stock, together with everything else in the decedent's estate, is large and is exposed to estate tax. The receipt of an inheritance is not a taxable event. If there's a tax, it's on the estate of the person who died. The money you receive is yours to keep. You don't pay tax on that. Some states have an inheritance tax where you do pay tax on that, not California. So that does not happen.
We had Oh, sorry, go
Yeah,
ahead.
I'll do one other and then see what you have. Why would you convert a business property where you might do a 1031 exchange into a residence? Mark alluded to that, where sometimes you have this property that's gone up in value and you want to use that $500,000 protection for the sale of your residence. So you might move into the rental, live there a few years, you sell it, and then you have that tax protection. It kind of makes the point, every situation's different. What makes the most sense? What are the tools that make the most sense for you? Okay, Mark, others that
Yeah, and Hillel has a good question there. Step up on investment accounts. And yes, anything in your estate when you pass away gets the benefit of a stepped up cost basis. Now, Mike talked about if you're married and one spouse passes away, your entire community property estate gets that stepped up basis. Separate property, only the person who passes away gets that their assets get the stepped up basis. We have some questions more about LLCs and as they relate to 1031s. So when we're looking at Prop 19 planning and property tax planning, absolutely LLCs are a part of that. It's actually not about the asset protection side. It's more about different rules for entities in California. We have other talks about this, but talk to us if you have questions about that, and we can absolutely help. We're helping a lot of families with Prop 19 property tax planning. It's an involved and sophisticated, complicated process. Again, lots of issues we have to weigh. So there's no one size fits all approach, but we can avoid property tax increases and we can achieve stepped up cost basis for your family while doing that. But if you make little mistakes here and there, we might lose one of those two benefits. So I think we've gone through so much here today. Great questions. So thank you, Hillel and Greg and Steve and Amy and all really good questions. Karen, we really appreciate it. And we can't get to everything here today. If you have questions, give us a call, 650-493-8070 or gilfix.com, gilfix.com. But spread the word. Let your friends and family know there are so many tools out there that we can deploy that can save so much. And it's not just about the ultra high net worth families that should do this. Whether or not you consider yourself high net worth or upper middle class or middle class, whatever. If you have a house, if you have stock, these are crucial issues. So we hope you got a lot out of this. So again, I'm Mark Gilfix. This is Michael Gilfix, Gilfix and the Pole Associates. Thank you so much for your time here today. Hope you guys stay safe, sane, and healthy. As my mom likes to say, take care.
Take care.